We left off in the last video with crude retesting the 62.50 level. It successfully held here and broke the highs of 64.89 and continued to move up to a high of 66.66. Today it's pulling back slightly after a positive day yesterday, with momentum still clearly up. Much of this rise can be attributed to the positive news from crude inventory reports, with 10 weekly draws in a row for crude oil and 11 weekly draws in a row for gasoline. We'll get the inventory reports out later this week to see if the trend continues. If we get another draw, we should easily break this previous high at 66 and continue on. If it does pull back, we should hold right around 64.91 and second level back to 62.50. However, most of the signs are pointing to a continuation of the uptrend. Gold broke through the top of the wedge that we drew in the last video and broke the previous high of 1362 and hit 1365. It does have the potential of forming a double top here if gold does sell off. However, given the upward momentum, we should see a break to the upside here. Taking a look at a weekly chart, it looks even better. We see it break out of this wedge, successfully retest, and rise up. If gold does break out here, we will look for it to break the highs around 1380 and then moving on to the 1400 level. Next, we'll take a look at the dollar. Here we see the support and resistance lines we drew in the last video between 90 and 91. It traded at the lower end of this range for a few days after, before breaking through to the downside sharply, testing the 89 level before breaking down again to the mid 88s. Today it's bouncing back up to 89 and change. The dollar is technically oversold here and could see a bounce higher, especially given this candle here, where we see the retracement back from 88.43 all the way back up to 89. Much of the recent decline in the dollar has been attributed to comments from the U.S. Treasury Secretary Mnuchin about the dollar, saying he's not concerned in the short term about the decline. The market took these comments as a softer dollar policy, even though that might not actually be the case. Another story bringing the dollar down is the rumor that China may be scaling back the purchasing of treasuries. This news was quickly denied, but it didn't stop the market from thinking about the possibility of such an incident. We do have some reports coming out this week that could help boost the dollar a little bit. If the U.S. payrolls show higher inflation and wage growth, we could see a slight bump in the dollar. Although inflation should technically hurt the dollar, traders have been buying the dollar on higher inflation news, thinking that the Fed is more likely to raise rates given a higher inflation rate. Also, the manufacturing PMI coming out later this week, if it shows strong economic growth, we could see a slight bounce, as the Trump administration has been focusing on manufacturing-related jobs. Those will be a couple things traders will look for. If we don't get any good news and the dollar continues to slide, we'll look for it to find support around the 88 level. Next, taking a look at bonds, specifically the 10-year. We have the two support lines that we drew again in the last video, which held for several days until last Friday, where it broke through and closed below and continued to the downside today, reaching a low of 121.180 before retracing slightly to 121.255. Bonds have seemed to notice something that the stock market hasn't. We looked at this graph in a previous video showing the projected decline in central bank purchasing over the next 18 months, projected to go to negative by mid-2019. The bond market is highly correlated with central bank balance sheets and purchasing. We can see here the correlation between total central bank purchases and credit spreads, which have been widening recently, not only due to the steadily rising rate of treasuries, but also highlighted here the recent outflow of U.S. high yield funds or junk bonds. Here we see the short interest ratio of the two biggest junk bond ETFs. The short interest ratio has been steadily rising in both, with a sharp spike up in one of the funds, all the way up to around 27 short ratio, which is alarmingly high. However, it's not just junk bonds, it's also investment grade corporate bonds. Here we see the largest ETF of investment grade bonds, whose short interest ratio also spiked at the beginning of the year, up to 5%. The difference in these two is understandable given the risk levels between the two. Junk bonds are obviously more inherently risky than investment grade corporate bonds. However, investors are seeking protection in both regardless of the risk level. Given this information, we see that the bond market is preparing for what this article is calling a credit quake. It could come in the form of another taper tantrum. Although we don't know when or how it will come about, it's clear that Wall Street is positioning in a way to protect themselves from such an event and also to take advantage when it actually does happen. The stock market, on the other hand, has not seen the same correlation recently with the declining central bank purchasing. Part of the reason is the recent increase of purchasing from emerging market foreign exchange reserve managers. We see the bulk of purchasing coming mostly from China, which in a sense has partly taken up the slack from the central bank reduction of purchasing and has helped boost stocks higher. This, along with the broad euphoria in the market, causing investors to buy at a pace not seen since the 1987 or 2008 crash, are some of the reasons we haven't seen the same correlation between central bank balance sheets and the stock market. We know there's a positive correlation between quantitative easing or central bank balance sheets on the way up. Looking at the top central banks in the world, the Fed, from 2008 to current, more than quadrupled, is currently at 4.39 trillion. The ECB, which more than tripled since the financial crisis, is now at 4.5 trillion euros and counting. Bank of Japan has more than quintupled. Looking at these central banks, it's pretty obvious to see where the price appreciation has come from in the market. It's easy to understand that pumping $15 trillion into financial markets will reverberate through the entire system and boost prices across the board. The question is, how will the market react or correlate with central bank balance sheets on the way down as we begin a tightening cycle? Despite this huge headwind for the market, we are still seeing broad euphoria. Bank of America's bull-bear indicator has now reached the extreme bullish level, which takes into account market sentiment and the pace of buying, which we noted in the last video was 58 billion into stocks in just 4 weeks. This indicator is claiming to have a 100% hit rate once triggered and drops an average of 12% afterwards. However, the timeline is somewhat ambiguous. Some happen within a month, others take a couple years. I don't think there's any doubt we'll see a pullback within the next 2 years, which makes this indicator possibly irrelevant. However, the data it collected is interesting. We do see every time this same indicator reached an extreme bullish level, a sizable pullback within a short amount of time. This was just a week, a month, 3 months, 3 months, 1 month, and so on. Given the current levels in the track record of this indicator, Bank of America expects a pullback to the 2686 level in the next couple months. One reason why this may not happen is the recent rhetoric out of the ECB. Mario Draghi, the president of the ECB, did announce that despite recently cutting its asset purchasing program in half to 30 billion a month, it stands ready to increase asset purchasing program in terms of size and duration if financial conditions become inconsistent with further progress towards a sustainable adjustment in the path of inflation. Basically saying if they see any weakness in the market, they're ready to ramp up money printing again. This is a safety net the market has been relying on since 2008, and it looks to be continuing. The market didn't have too much of a reaction to this news, possibly because they already believed that the central banks wouldn't allow the market to fall. Despite this, there will come a time where no amount of QE could save the market. Looking at a chart of the S&P, here we see a 5-year daily. This was the unprecedented year we had last year, a market which was already extended. However, it's just gotten even crazier since the beginning of the year. We see a near vertical rise since the beginning of the year, with RSI hitting a high of around 87 and currently at 80 today. We see MACD almost off the charts and again at an all-time high. To put where we are in perspective, we can look at a longer term 20-year monthly chart. Here we see the previous bubbles, dot-com bubble in 2000 and the housing bubble in 08, both around 1575 level. Today we're at 2861. The rallies from the low here were realistic considering the onset of QE from the Fed. However, we still had sizable pullbacks on the way up. But as this market has continued on, as well as QE programs across the world, we see behavior get even stranger. Even after last year's sharp climb, we see what looks to be the largest candle body in the last 20 years to the upside, and will likely close near the top for the month. This is part of the inflow of 58 billion we talked about, the emerging market forex reserve managers buying, and just a visualization of market euphoria. You see in the news that they're still talking about the tax plan and how much money it's going to save all these companies, and they're still pricing it in even higher. But they were pricing all this in for the entire year last year, as well as the infrastructure plan and healthcare reform. How much more can actually be priced in? On a long-term chart like this, it certainly does look like a blow off top. Taking a look at Bitcoin, as we've been doing, it's currently at 11,150, down 4.6% today. It recently came under fire after the largest crypto heist in history, where hackers stole over $500 million worth of NEM coins from a Japanese exchange. This caused the NEM coin to fall over 20% overnight, pulling down the broader market. However, it came all the way back after the exchange announced it would be providing refunds to everyone who lost their NEM coins. The exchange would be paying these refunds out of their own capital, which made the traders happy and instilled some faith back into the crypto market. However, this isn't the first of crypto hacks. It doesn't seem like they're able to stop the hackers despite security measures. And exchanges aren't always going to be able to provide refunds, especially if it starts to happen more frequently and with larger amounts. Bitcoin was also affected by this news, dropping slightly before also recovering. However, the recovery was quite weak and is continuing to sell off. Taking a look at a 3-month, it's still clearly in a downtrend, continuing to put in lower highs. There's a large short position building in Bitcoin, which could cause a short squeeze if prices were to rise sharply. However, that doesn't seem to be the case recently, as every small rally has been sold into. We'll have to watch the 10,000 level closely as we get closer and closer to it. To wrap up, I wanted to go through some current global events which could be potential market movers. First, we have the US debt ceiling and the government shutdown battle. We have yet to actually pass a budget and instead keep passing continuing resolutions to delay the bill. The continuing resolutions have become shorter and shorter, meaning the frequency of a potential shutdown is increasing. This is a concern as the dollar is already tanking and Treasury yields are rising. It doesn't look good for the US if we can't even get a budget passed. The uncertainty might cause foreign countries to dump US debt. Syria is back on the table as tensions tighten. Putin ordered a large percentage of Russian troops to leave the area, leaving the government vulnerable. This leaves the door wide open for another foreign force to invade Syria, most notably Turkey, who has been pecking away at Kurdish tribes in Syria for quite some time. This is especially concerning given that the US supplies both money and weapons to the Kurds, and Turkey is technically a NATO member and a US ally. However, the president of Turkey does seem to want to leave NATO. This is a tense situation between multiple nations which could come into play relatively soon. Another thing to think about is the Olympic Games, which are being held in South Korea, which seems odd considering the extremely high tension between North Korea and the rest of the world. Although the threats have seemed to have stopped recently, we know that Kim Jong-un and the regime is incredibly unstable and unpredictable, and it doesn't seem out of the realm of possibilities that North Korea would try to pull another missile stunt during the Olympics. Finishing up, we'll take a look at the economic calendar for the week. Tomorrow the FOMC meeting begins, but we won't likely see any change in policy until March, most likely. Wednesday we get ADP employment report and EIA petroleum report. Thursday we get jobless claims, PMI manufacturing, construction spending, and ISM manufacturing index. And Friday we get employment situation, consumer sentiment, factory orders, as well as the Baker Hughes rig count.